Okay, let's talk about how to use this sheet as a way to review uncollectibles that we talked about. So what are the two ways of accounting for bad debt? So we have two methods, and the first one is called direct write-off. We learned this one first, and we also learned that it is not in compliance with GAAP because it does not match the bad debt expense in the same period as we record the sales. So if we need to use GAAP rules, we will use the allowance method. We can call this the allowance for doubtful accounts method. This method can be used with GAAP because right away we record the bad debt expense. So bad debt expense will match the revenues that we created or received in that period. So what are the two methods to estimate bad debts under the allowance method? So we have two ways to estimate. The first one is called the percentage of sales method. And remember that of in accounting or math means multiply. So all we do is take the percentage of that we estimate, and they'll tell you the percent to use. For example, 3/4% times the amount of the sale. So if the sale was $1 million, you would take the percent amount times the $1 million. And that number would be your adjusting journal entry. The other method is called the analysis of receivables. This is where we look at the aging of the accounts receivable, and using those numbers, we calculate. And when we calculate, we are determining how much we want to be in our allowance account. So if we want to know how much to make our journal entry for, we find out how much is in our allowance account and find out how much we want it to be now and get the difference, and that is how much we make our journal entry for. So that's the main difference in these two. The calculation here tells you how much to make your journal entry for. The calculation here tells you how much you want in your allowance account. So you have to back into your adjusting journal entry. Okay, the next question. Name two ways a company might conclude that a particular customer's account has become uncollectible. So regardless of which method you use, we need to know when we're going to write off the customer's accounts receivable. There's several ways to tell, but one way would be if you lose contact. Sorry about that. If you send an invoice and it gets returned to you, or if you try to call them and they don't answer or their phone is disconnected. Another way is if you receive bankruptcy notice. In other words, the person that owes you money has filed for bankruptcy. Then it may be time to write off their account as uncollectible. If you are owed money from a company that went out of business, then it might be time to write it off as uncollectible. Here's an example where we're going to look at the following as using the direct write-off method. So received $1,200 from Laura Cole and wrote off the remainder owed as $3,900 uncollectible. So it's July 9th and we received cash, so cash goes up by $1,200, and cash is an asset, so we debit it for $1,200. And wrote off the remainder of $3,900 as uncollectible. Since it's the direct write-off method, I immediately use bad debt expense for the amount that is uncollectible, $3,900. So the total amount of accounts receivable that needs to go away is the $5,100. The $1,200 plus the $3,900 is now off of the accounts receivable. And the subsidiary account would be Laura Cole, so add that to the entry. On October 11th, we reinstated the account. So what happened here? Laura Cole decided that she did want to pay us for whatever reason. But the first thing that we have to do is undo the write-off. So what does that mean, undo? It means I want to undo this bad debt expense portion, the $3,900 and the $3,900 of the accounts receivable. So I'm going to write our account back on. I'm going to debit accounts receivable for the $3,900. she will be paying us, so we have to put it back on her account. And then undo the bad debt expense because she's going to pay us for $3,900. So now this reinstates the account, and now I need to receive the money that she paid. So debit cash because cash is going up, and then credit accounts receivable to make her accounts receivable balance zero. Not because she's not paying us, but because she actually paid us now and she doesn't owe us. And that is how you do a reinstatement, or a write-off and a reinstatement using the direct write-off method. Now let's look at how to do it if you use the allowance method or the gap method. We received $1,200 from Tracy Busby, and we're using the allowance method. So we're going to debit cash still for $1,200 because we received cash. But for the amount that we're going to write off, we're going to debit the allowance account. So we're going to use up some of our bucket here. So we'll still get rid of our accounts receivable for the portion we received and the portion we wrote off. And then on October 11th, we're going to be reinstating it, and we're going to reinstate the portion that we wrote off, which is the $3,900 for the allowance for doubtful accounts and the portion of accounts receivable of $3,900. So here is the reinstatement entry. And here is the entry to receive the cash from Tracy Busby on her account. Now the key to this one is before we could use our bucket, we need to set up our bucket. Now this problem did not have us do that, but in order to understand why we debit allowance for doubtful accounts, here we would need to see that. So let me show you quickly how that would have come about. Okay, so before we would have made this actual write-off, we would have set up our actual allowance account. And we would have used either the percentage of sales method or the analysis of receivable method. We would debit bad debt expense for some large number, let's say $10,000, and we would have set a credit to allowance for doubtful accounts for $10,000, and this would have been our adjusting journal entry. And then this would be used throughout the year to write off actual accounts. So when we found out that Tracy Busby wasn't going to pay during the year, instead of hitting our bad debt expense account, again, we won't because we've already done that at the beginning of the year. So our bucket has a credit balance of $10,000. So when we use up some of that bucket, since it was a credit, if we want to use some of it up, we debit it. So that's how our allowance method works. We set up the bucket at the beginning of the year, and that's the only time we record bad debt expense. So when we find out who's not going to pay us throughout the year, that's when we use some of the bucket or the allowance account to write off their accounts receivable. Okay, so the percent of sales method, this is that entry that I just showed you. So you're going to do your bad debt expenses 1/2 of 1%. So do 1/2 times 1%. Well, half of 1 would be 0.5%. And then if you change that to a decimal, you would get 0.005. So then you have to multiply that by your sales amount, which is $3,500,000. So the entry to record the percentage of sales, the allowance method. The allowance method is always a debit to bad debt expense and a credit to allowance for doubtful accounts, and the number you should have gotten in your calculator is $17,500. Now we're going to place these beginning balances in the T account and see how we use this information. So it says at the beginning of the year, accounts receivable has a balance of $800,000. So we're going to put $800,000 on the debit side because it has a normal debit balance. And then it says that allowance for doubtful accounts has a credit balance of $7,500. And then I see that sales were at $3,500,000. Sales is a normal credit balance. So I've entered the beginning of balances. Now it says to post the above entry. So posting this means I'm going to be putting it into an account. So bad debt expense would be debited for $17,500. And then allowance for doubtful accounts is credited for $17,500. Now we just have to answer these questions. What is the adjusted balance for accounts receivable? So what's in accounts receivable? $800,000. Then the next question, what is the adjusted balance for allowance for doubtful accounts? You would add these two numbers together, so 7,500 plus 17,500, which would be 25,000. So 25,000 there. What is the adjusted balance for bad debt expense? We'll look at bad debt expense, and it is 17,500. And then what is the net realizable value of accounts receivable? So the net realizable value is your accounts receivable minus your balance in your allowance for doubtful accounts. So if I do 800,000 minus 25,000, I would get 775,000. So that is the net realizable value. Your accounts receivable balance minus your allowance for doubtful accounts balance. And that is how much I think I'll actually get from my accounts receivable. Let's look at the last one. This is very similar to the previous problem, except it's asking us to estimate using the aging of receivables method. Let's see why this changes. What is the adjusting entry for the uncollectibles account? Well, we estimate that using the analysis of receivables method that this will be $30,000. But instead of this being the number we actually use in our entry, we need to see how much we need this to get to 30,000, the allowance account. So let's see what I mean. Here's what I mean. First, we need to put the beginning balances into our T account. So I'll go ahead and do that. Okay, so I've entered my balances into the T accounts. Now, here's what it's saying. We want my ending balance in the allowance account to be 30,000. So how much do I need to put into my adjusting journal entry to get my 7,500 to the 30,000? If I subtract 30,000 from 7,500, that'll tell me how much I need to put into the account. So I did that, and my adjusting entry needs to be for 22,500 in order to get my account to get the 30,000 that I calculated. So I would debit bad debt expense for 22,500 and credit allowance for doubtful accounts for 22,500. So what I'm doing here is I'm filling up my bucket to get it to be the 30,000 that we had calculated it to be. So what is the adjusted balance for accounts receivable? Well, it's 800,000. And then what is the adjusted balance for the allowance for doubtful accounts? We got that to be the 30,000. And then what is the adjusted balance for bad debt expense? Well, now that is 22,500. We need to post that in our entry. And then the net realizable value of accounts receivable is going to be your accounts receivable minus your balance in your allowance for doubtful accounts. So 800,000 minus your 30,000. If you subtract that, your net realizable value, you expect to collect 770,000 of accounts receivable. Let me know if you have any questions.